So we'll get back to the topic of rental yield. Now, most of you know, so rental yield is rent amount over the year divided by the purchase price. And a rule of thumb will be, if you have a $500,000 property earning $500 a week, that's a 5.2% rental yield. That is still not enough to earn positive cash flow. How high do you have to go? You're actually going to have to look at rental yields of above 10% to achieve positive cash flow. So very high levels. I mean, borrowing costs are typically around 5% at the moment. The cheapest is sort of around 4.8. People are still paying up to about 5.8, 6% in some circumstances. So a 10% gross yield will probably work back to around a 6% net yield. So you're going to need somewhere around 10% plus to achieve positive cash flow. The other factor that will help you to achieve positive cash flow is if you can get negative gearing benefits through income tax refunds. Now, if there's a loss incurred on your property and you are earning income and paying income tax from other sources, you'll be able to claim a tax deduction for that loss and hence get tax refunded. This makes your cash flow more positive and is a way to achieve affordability of owning investment properties. You can have a situation where technically you are making a taxable loss on your properties, but thanks to tax refunds, it's actually cash positive. And the way you can do that is through achieving non-cash tax deductions. The biggest one of these is claiming depreciation on fixtures and fittings and the special building write-off. To get the benefits for this, you will need to have a depreciation schedule prepared by a quantity surveyor. Typically that will cost around $500, and you can use that report for the lifetime of your ownership of the property. And that will allow you to write off depreciation on the fixtures and fittings. Now, things that are fixtures and fittings in a property are light fittings, window treatments, oven, air conditioner, floor coverings, hot water system, things like that. So I'll give you a ballpark figure. A $500,000 existing house might have $30,000 worth of fixtures and fittings, and they would be depreciated on average at 20% a year. 20% on $30,000 is around $6,000 of tax deductions that you might get on that property. That $6,000 tax deduction, if you're on a 30% marginal tax rate, is worth 30% of $6,000 or around $1,800 cash flow back to you in income tax refunds. The other part of the depreciation schedule that you can benefit from is the special building write-off. So that is a tax deduction available on the construction cost of homes built after 1985. There's different rates for that, and the quantity surveyor's report will show you how much you can claim. You won't be able to claim anything on houses built before 1985. But even with those older houses, if they have had construction incurred on them after that date, you may be able to claim. So for example, if a granny flat was added or some renovations built an additional rear portion of a house, you should be able to claim special building write-off on that as long as you have that quantity surveyor's report. So those will give you non-tax deductions. You're not actually paying out physical money for the decline in value of the building or the depreciation of the fixtures and fittings, but you can claim a dollar figure in your tax return. Now there is a catch with this, and that is, once you have built a large property portfolio, and let's just say you're above 8 or 10 properties or more, you will end up having more depreciation available than you can use in your taxable income. After 8 or 10 houses, your taxable income from your work is probably down to zero, and you will get no further benefit from these non-cash deductions. So I'd just be wary of this, and again, it makes it harder to achieve positive cash flow once you're up at 10 plus properties. Of course, if you push up your income through your work, each time you've got a higher income, there's more taxable income available there, and you kind of refresh the amount of negative gearing available. There are 3 areas of design of property that you can work on to achieve positive cash flow. The first one is a high rental yield. The second one is you having a high taxable income. And the third one is having non-cash deductions, typically through a new property. So If you look at high rental yield, you can either do that through new houses or through existing houses, but you'll be looking at situations where the rent level is high. So this can be regional areas, it can be outer suburban areas, or it could be inner suburban if you are able to fine tune it perhaps by furnishing a property and going for short-term tenancies. These are all things that you can do to get higher rents. The next one is you need that high taxable income. If you can get up to around that 47, 48 cent tax bracket, it is a lot easier to achieve positive cash flow. And so that is more available to high income earners. If you're down in a very low income, you will have to work a lot harder to get positive cash flow because you'll actually have to generate it from the rent itself rather than from the tax deductions. And the third feature is newer properties. Newer properties are going to get much higher special building write-off and also depreciation on fixtures and fittings, and so you will get a much bigger tax deduction. So if you can combine a high asking rent, you have a high taxable income, and your house is fairly young, you'll probably be able to achieve positive cash flow. If you want to select properties that contain those features, talk to me, Adam Bettison, and we can customize a portfolio to match your personal situation.